Assalamualaikum warahmatullahi wabarakatuh.
Hello everyone, my name is Annisa Nurul Fitri, NPM 244120007, Accounting Class 24A. I will present material about meaning of accounts, 5 types of accounts, normal balance for each account, and how to enter transactions into the general journal. In accounting, account is a term used to group and record financial transactions based on their type. Each account reflects one particular element of the financial statements and is used to track changes that occur in an entity's assets, liabilities, equity, income, and expenses. Account definition. An account is a special place or record in an accounting ledger that is used to record changes in value due to financial transactions. Accounts provide a detailed description of certain items in the financial statements. In accounting, there are 5 main types of accounts, namely assets, liabilities, equity, income, and expenses. Each has a normal balance, which is the side, debit or credit, on which the account usually increases. 1. Assets, asset. Definition. Assets are economic resources owned or controlled by a company to support operations and generate future economic benefits. Examples of accounts.
Cash,
Accounts receivable. Inventory.
equipment, land,
Normal balance, debit. Debit records an increase in assets, receiving cash. Credit records a decrease in assets, paying off debts with cash. 2. Liabilities, kewajiban. Definition. Liabilities are obligations or debts the company owes to other parties to be settled in the future. Examples of accounts. Accounts payable. Bank loans payable. Taxes payable. Unearned revenue. Normal balance. Credit. Credit records an increase in liabilities, receiving a loan from a bank. Debit records a decrease in liabilities, partial payment of a debt. 3. Equity, equitas. Definition. Equity represents the owner's rights to the company's assets after deducting all liabilities. Examples of accounts. Owner's capital. Retained earnings. Drawings for sole proprietorships, personal withdrawals by the owner. Normal balance, credit. Credit records an increase in equity, the owner adds more capital. Debit records a decrease in equity, the owner withdraws money for personal use.
4. Revenue, pendapatan.
Definition. Revenue is the income earned by the company from its primary business activities, such as selling goods or providing services. Examples of accounts. Sales revenue, service revenue, rental income. Normal balance, credit. Credit records an increase in revenue, receiving payment for sold goods. Debit records a return or correction to revenue, customers returning goods. 5. Expenses, beban. Definition. Expenses are costs incurred to support the company's operations. Examples of accounts. Salaries expense, rent expense, utility expense, marketing expense. Normal balance, debit. Debit records an increase in expenses, paying office rent. Credit records a reduction in expenses, correcting an overpayment of expenses. Recording transactions in the general journal. Recording transactions in the general journal is the first step in the accounting process, using the principles of double entry accounting. Every transaction affects at least 2 accounts, ensuring that the total debit equals the total credit. Steps to record transactions. 1. Identify the transaction. Understand the transaction, including its type, value, and affected accounts. Questions to ask. What was bought or received by the company? How was it paid for, cash, credit, or other methods? What is the impact on the company's accounts? Example. The company purchases office supplies worth IDR 1 million in cash. 2. Determine the affected accounts. Each transaction impacts at least 2 accounts, following the debit and credit principle. Example. Office supplies, asset increases. Cash, asset decreases. 3. Determine normal balances and positions. Understand the normal balance for each account to decide whether to record it as a debit or credit. Example. Office supplies, asset, increases, recorded as a debit. Cash, asset, decreases, recorded as a credit. 4. Prepare the general journal entry. Record the transaction in the general journal using the standard format. 5. Verify debit and credit balances. Ensure that the total debit equals the total credit for every transaction. If not, there's an error in recording. Conclusion. 1. Accounts are essential components for recording financial transactions. 2. There are 5 main account types, each with its normal balance. 3. Recording transactions in the general journal involves identifying the transaction, determining accounts and normal balances, and properly recording the entry. 4. The double entry accounting principle ensures a balance between debits and credits.